All right. Okay. So today we're going to talk about, and this is our last one for the series, and then I'll take usually about a month break, maybe 6 weeks or so. It depends on how many new agents we have coming in, and then I'll send out an email. I keep everybody on the email list. I'll send everybody an email, let you know when we're starting them back up again. If you want to join, go through the classes again, and or if you know any new agents that maybe joined your office that you want to encourage them to join, the more the merrier. So anyway, today is going to be the last the last class, and my full disclosure here is that I'm not a CPA, I'm not a financial advisor, I'm not an attorney, but I'm going to talk to you guys today a little bit about your business itself. So and how to some of the options that you have for structuring your business to take advantage of some of the tax benefits that we have available as self-employed real estate agents, some different retirement aspects, things like that. So I get a lot of questions about, being self-employed and how can I save for retirement, or a lot of times I don't get those questions. And I think that's a really important question is how do I prepare for my future so that I don't have to be 80 years old still selling real estate if I don't want to. So, we should make sure that we're well prepared for that, portion of our lives, and, get us to a point where we can, enjoy our lives and enjoy the money that we made. So, I also, it's kind of super late notice especially for those of you up north, but a big part of, my belief in preparing for retirement is to, first of all, practice what you preach and understand that real estate is an incredible resource for us. An incredible resource for us to save for retirement. And again, it's kind of practice what you preach. We believe strongly, or you should believe strongly, in the power of real estate and the power of leverage as far as a financial vehicle is concerned. And we get to know kind of the inner workings, and we get some inside access to some things. Sometimes we get some deals that, we might be able to take advantage of ourselves. Maybe we get a listing that we decide, hey, we'll just buy it from the client. So there's a lot of different advantages that we have. And the biggest one, in my opinion, is that you can use your commission towards down payment. So when you go and you purchase a property, you can use what you're getting paid for that towards down payment on the property. So it's kind of a nice little thing. And essentially you need to make a paycheck, you can go buy a property and make a little commission on it. So anyway, I do think you should kind of practice what you preach. I do investment classes or investment seminars once a month. And tonight is when I'm doing one of them here in the Westminster location. So we have an education center here in our Westminster office. Tonight at 6 p.m. We are doing an investment seminar. So if anybody's interested in doing that, I apologize for those of you that are far away. It's kind of late notice, or even for anybody, it's late notice. But for anybody that wants to come to it, you're more than welcome to. I do these seminars actually to try to get clients. So, and I do them for my team. So my team brings in their agent or their clients. They kind of show, hey, this is what our team does. I do a presentation about building wealth through real estate, how to acquire real estate, what to look for in rentals, what type of returns to expect, that kind of stuff. So anyway, you guys are always more than welcome to come to those. If you can't make it and you have some interest, just let me know. I'll let you know when we do the next one. I try to do them monthly or every 4 to 6 weeks or so. But that's really how I built my business, is on investment real estate. So anyway, that's number one. I think you should strongly consider building yourself a real estate portfolio. I know some people in the business have, said, hey, my goal is to do, use my commissions and buy and purchase one property a year, which is incredibly ambitious. And usually, you should have a good income to be able to do something like that. But imagine being able to do that for 10 years or 20 years and own 10, 20 properties. By the time you're done, you'll be set at that point. So I think that's a great goal. So anyway, We're going to talk about a little bit about retirement stuff, tax stuff, some, what to look for your deductions, a couple of different tools that you can use for this type of stuff, and kind of go from there. So I'm going to do a quick screen share. And we're going to go over a couple of different websites. So I'll pull these over. I'm going to redo my screen share. Give me 1 second. All right, there we go. Okay, so, all right, a couple of different things. So as a self-employed person, okay, we are 1099 employees, means we get a 1099 at the end of the year. We file taxes as a self-employed person. We can write off our business expenses, so on and so forth. There are some benefits of being self-employed, and then there are some things that are negative. Probably the biggest negative is self-employment tax. Okay, so when you are a W-2 employee, you pay taxes on your wages, and so does your employer. Those taxes are right around 15%. Okay, and they're split between you and your employer. So your employer pays 7.5%, you pay 7.5%. When you're self-employed, you are your own employer, which means you pay the entire 15%. Okay, so if you make $100,000 in a year, you're going to pay 15% self-employment taxes. Okay, where somebody who is a W-2 employee that makes $100,000 a year, they're going to pay $7,500 of that. They're going to pay half of that. Okay, those are your Medicare and basically your Medicare expenses. Okay, and your Social Security. Okay, so so that 15% when you're self-employed gets taken pretty much off the top. Okay, one of the things that you can do to shelter yourself from that, and also to give yourself some other benefits, is to create what's called an S corporation. And I'm going to send you guys all these articles. Okay, so I'll send these over to you. You guys can read them. You don't need to take screenshots or anything like that. Okay, first thing I recommend is potentially looking into putting yourself into an S corporation. Okay, an S corporation, first of all, is the manner in which you file taxes. Okay, so an S corporation generally is an LLC. So what we do is we create an LLC for ourselves. Okay, whatever you want to call it. So for me, my company is Meta Homes. Okay, that's what I advertise. I've shown you guys stuff like that before, but Meta Homes is my company. So Meta Homes is an LLC. Okay, that LLC actually falls under a bigger umbrella that I have, which is NPCC, which is Nick Payne's Coaching and Consulting. And that is my main LLC. So everything else kind of falls under that. So I file all of my taxes under NPCC. That is an LLC, and it files taxes as an S corporation. Okay, so S corporation is the way in which my LLC files taxes. Okay, so if you read kind of this first line here, it says S corporations, like partnerships, are pass-through entities. Okay, which means there are no federal income taxes levied at the corporate level. So instead, an S corporation's profit is allocated to its shareholders, which, if you're self-employed, is you. So for example, I am the only shareholder, I am the only employee of NPCC. Okay, so I'm the only shareholder, and it's taxed at the shareholder level, which means it's taxed to me as an individual, not to the company. Okay, so that's the first thing to know. Okay, what happens with an S corporation is that you kind of get around the self-employment tax. Okay, so not all of it, but some of it. And here's essentially how it works. Okay, when you're an S corporation, there's two ways that you can pay your officers, or the people who are the shareholders of your company. Okay, so again, keep in mind, you are the only shareholder. Okay, so because you're A, a shareholder, and B, an employee of your company, you get paid in two ways. The first way is you need to establish a salary for yourself, or some type of wage. Okay, so you're going to pay yourself, say, $50,000 per year. Okay, but let's say you as a real estate agent make $100,000 in gross commission. Okay, and that $100,000 gets pushed over to your S corporation. Now your S corporation has $100,000 in profit. So what your S corporation is then going to do is it's going to pay you as an employee $50,000. That's your salary. Okay. On that $50,000, you have to pay the 15%. Your S Corp is going to pay 7.5%, and you are going to pay 7.5%. Okay. So you're going to pay a total of 15% on the 50,000. However, the other 50,000, you're going to distribute, okay, to your shareholders, which is you, as profits or basically stock. Okay, so you're now a shareholder. You get $50,000 in distribution. Because it's not an employment, it's not a wage. It's not taxed in the self-employment tax. So now instead of, if you were just a regular self-employed person, you would pay 15% tax on $100,000. With an S corporation, you're going to pay 15% tax on $50,000 and no tax on the other 50,000. Okay, does that make sense so far? Kind of confusing. Again, talk to your CPA, but okay, this is the way that we kind of avoid some of that self-employment tax. Okay, so you can see here that the example here, Larissa is the sole owner of her S corporation. It's an advertising agency. We're going to say it's a real estate agency. Her revenues from the business are 110,000, and her annual expenses, not including her own compensation, is 20. So she gets to deduct her expenses, and now she has $90,000. She pays herself $50,000 in salary, and then that $40,000 is profit, means she doesn't have to pay self-employment tax on the 40 grand. So what we just said. Okay, so it goes into a little bit more stuff. You have to pay yourself a reasonable wage. Okay, so and there's a lot of ins and outs of this, but you cannot pay yourself, if you make $100,000 on the year as a real estate agent, you cannot pay yourself a $10,000 salary. Okay, the IRS is going to look at that and go, no. You can't do that. You can't dodge 90% of your taxes using an S corporation. Okay. So again, this is something to talk to your CPA about, but generally kind of the rule of thumb is 50%. You can distribute 50% and pay yourself 50%. Okay. So S corporation. Okay. You get to forego some of the self-employment taxes. Okay. This talks a little bit about determining a reasonable salary, that kind of stuff. So you can read up on that. And one of your best friends in this stuff, if you like to read about it, if you're dorky like me and you like to read about tax law, you can go to the IRS's website, irs.gov, and read up on a ton of this stuff. Okay. Now, the second piece of an S corporation. Okay. S corporation gets this next piece, which is called a deduction for pass-through income. Okay, so a deduction for pass-through income, this is something that was put into play a few years ago or in the prior tax plan, and might go away depending on the current administration's tax plan that they push through. But what this does is it allows you to do what's called pass-through income. So you can qualify for a deduction of up to 20% of your share of the S corporation's profit. Okay, so let's talk about this again. $100,000 in GCI, okay, or in profits for the company. You get $50,000 paid in salary, and you get $50,000 paid in distributions. Okay, that $50,000 in distributions gets a deduction of 20%. Okay, which means 20% of 50,000 is 10 grand. So it means that $10,000 is passed through. Okay, $10,000 of that income is passed through to you tax-free, which means now out of that 50 grand, instead of 50,000 of it being taxed at 15%, 40,000 of it is taxed at 15%. Okay, at $100,000, that's going to save you $1,500 right there. The big thing to take into consideration here is that you, as you grow in this business, for people that are doing significant amounts, $200,000, $300,000, $400,000, $500,000, when they're passing through, for example, when they've taken $250,000 in distributions and they get a 20% pass through, that's saving them taxes on $50,000. Okay, so this is really, really significant. This adds up. They're the high earners in this industry that are not using S corporations are losing tens of thousands of dollars in taxes. Okay, so make sure that you understand that you can pass through 20% of the profit tax-free. Okay, so two big advantages of running an S corporation. Okay, the 20% pass through. Okay, and the ability to not pay self-employment tax on at least half of your wages. Okay, this can go down a huge rabbit hole. There's all kinds of ways that you can determine a reasonable salary and actually do better than 50-50 and do 40% as salary and 60% as distribution. There's all kinds of ways that you can manipulate this, but something to talk to your CPA about. Okay, so that's number one. And I will tell you that the additional expense, there is an additional expense of owning an S corporation, and that is when you file your taxes. Now you have to file a corporation return and you have to file your individual return. Okay, so corporation return is generally going to be about $1,000, maybe $1,200 or so, in addition to your individual tax return. So there's a breaking point where an S corp makes sense. If an S corp is only going to save you $1,000 in taxes, you're going to end up paying that back in the cost to file taxes. So maybe you don't want to do that. And that break even is probably somewhere around $75K a year, $60 to $75K a year. So if you're making more than $75,000 a year in real estate, you should be incorporated. Okay. Any questions on that? All right. Good thing we're recording. You guys can always come back and look at it later. So, all right. So that's the first piece, S corporation. Okay, I highly encourage you guys. And let me tell you one more thing about an S corporation, kind of the why you get these benefits. So an S corporation essentially is a promise to the IRS that you're going to have better record keeping than the average self-employed individual. Okay, it means that you're going to itemize deductions. So you're going to have some type of QuickBooks or something like that you have itemized deductions. I spent this on advertising. I spent this on home office. I spent this on cell phone, and it's going to be itemized. When you're self-employed, you can just kind of take, well, you shouldn't, but you can take kind of a flat deduction. And then, if they ever come audit you, you hand them a shoebox full of receipts and go, good luck, figure it out. An S corporation is going to have a little bit more structure than that. And the IRS requires a little bit more structure in the tax return itself. So your CPA is going to tell you, hey, we need a little bit more organization in terms of your write-offs. So that's kind of their trade-off is, hey, pardon me, we'll give you a little bit of a tax benefit, but your taxes need to be cleaner when we review them. Okay. All right. So let's talk about about a couple tax things, whether you're self-employed or S corp. Let's talk about some of the deductions that you can take. Okay, so first of all, home office deduction. Okay, a lot of us are working from home. Okay, have some type of office set up at home. This is a good article. I'm not going to read through this whole thing, but the idea is if you're self-employed and you work from home, you can deduct some of the expenses that you take on at your house. The way it generally works is that you can take whatever percentage your home office is of your entire house. That's what you can deduct from those expenses. So for example, if you have a 1,500 square foot home and you have a 150 square foot office, that's 10% of the size of the home. That means you can deduct 10% of your utility costs, 10% of your mortgage or your rent, 10% of your internet bill, so on and so forth. So you can, that's one of the ways that you can do that. So when you read through here, you'll kind of see that. They also offer a simplified option. I recommend this. And this is a great way to get a quick deduction off your taxes without having to keep track of anything. So the IRS introduced a simpler option for deducting your home office expenses in 2013. Instead of keeping your records of all of your expenses, you can deduct $5 per square foot of your home office up to 300 square feet. So a maximum of 300 square feet for a maximum deduction of $1,500. Okay. So as long as you qualify, as long as you work from home somewhat, okay, you can take this tax break and you don't have to keep records of specific expenses. So this is just a right off the top, $1,500 deducted from your earnings that you don't have to pay taxes on. Okay. If you have significantly, larger and generally speaking, our actual home office deductions would come out to be higher than that. If you want to do good record keeping, do good record keeping, and you probably have a bigger number than 1,500. Okay, so good article on home office deduction. Again, I'll send these guys over to you. Okay. All right, let's talk a little bit about your deductions. Okay, I have found so many people that don't keep good records of what they spend. Okay, this is huge. We spend a lot of money on real estate, guys. It's insane how much we spend and how many deductions there are out there that we can make sure that go against the profits of our business so that we're not paying taxes on things that we already paid for. Okay, so this is a good little website, little article that talks about some of the deductions that we can take. Okay, so let's review some of them. First of all, we can deduct mileage. Okay, we drive a ton. I think deduction for this year is somewhere like 56 cents a mile. Okay, if you drive 20,000 miles in a year, you get to deduct like $11,000 worth of mileage. Okay, the other thing that you can do is if you don't want to keep track of your mileage, okay, you can deduct actual expense of your travel. Okay, so what that means is, this is a good opportunity for those of you, for example, that lease a vehicle. If you lease your vehicle, you can write off, if this is a business vehicle, and let's say you use it for business 100% of the time, even if you don't, even if you use it 90% of the time, you just make these same calculations and then multiply it by 0.9, but you can write off your lease amount. You can write off the cost of your gas. You can write off the cost of new tires, the maintenance of your car, anything that you spend on your car, your insurance on your car, anything like that, you add all that up for the year, okay? And you can deduct that at whatever percentage you use your vehicle for business. Okay, this is huge. This is why a lot of real estate agents drive really nice cars, because they can have $1,000 a month lease and they just write it off. It doesn't mean they don't have to pay for it, but they at least save taxes on it, right? So by the time you lease a car versus buying a car, it's almost worth it, right? Like if you're in the 25% tax bracket and you've got a $1,000 a month car payment, it's the equivalent of having a $750 a month car payment, because you're saving that in taxes because you write that off. Okay, so you can write off your health insurance premiums. Okay, write off your home office. We just talked about that. Any supplies you have for work. Okay, this includes clothing. Okay, so for example, if I'm not working, I'm wearing gym shorts and a t-shirt. That's what you're going to find me in. When I'm working, I'm in, slacks or nice clothes or button-up shirts or whatever. I go shopping and I buy myself new clothes for work. That gets deducted. That would be considered uniform for my job. Okay, travel. Okay, if you're traveling for anything, if you go to any of the RE/MAX, get-togethers or seminars or whatever it is, you can deduct that. So we have all kinds of regional get-togethers for RE/MAX. They're in Orlando and they're in Seattle and Las Vegas, and go to them right off the trip and go have fun. Go spend a couple days there, and spend a couple days on your own and go write it off. Okay, use an excuse. Use your business as an excuse to write off a quick vacation. Okay. Car expenses, we already talked about that. Okay, your cell phone. I don't know about you guys, but my cell phone is used 95% for business. Okay, so my cell phone bill gets written off. Okay, if you have business insurance, okay, we pay E&O. All the fees that we pay for real estate, all of our Association of Realtors fees, our RE/MAX fees, your desk fees, everything that you pay for RE/MAX and any associations that you're with are 100% tax deductible. Okay. Commissions or fees, if you pay any commissions or fees, any classes that you take that you pay for are tax deductible. And then depreciation of assets. Most of us don't have significant depreciable assets in the real estate business. This is more like if you owned a construction company and you owned a bunch of construction vehicles or big trucks or something like that, that you could depreciate those. Okay. So anyway, this article goes over each of these things that we just talked about. So read over those. And then we've got this list of some other stuff. Advertising is huge, okay? And guys, remember, your forms of advertising there's tons of forms of advertising. The signs that you purchase, to list a home, to put out in front of a home, that's advertising. You're advertising that that home is for sale. Okay. You do Facebook ads, that's advertising. Okay. Any promotions you do, any mail that you send out, any mailers that you send out, that's advertising. If you print up, little notebooks with your name on them or whatever, and give them out to your clients, that's advertising. Your closing gifts, they're advertising. It's a way to promote your business. It's advertising. Write it off. Okay. Office expenses. Okay. Your anything obviously that you do at work. If you buy pens, paper, pencils, whatever, any of that stuff, it's all deductible. Okay. Repairs and maintenance. Okay. Again, for stuff that you use for work, taxes and licenses. We already kind of talked about that stuff. Rent or lease vehicles. We talked about that. Your utilities and your home office deduction. We already talked about that. Contract labor. You hire somebody to go show houses for you and you Venmo them $50, it should be written off. Put it in your file to deduct. Okay. If any of you have employees, obviously that's deductible. Okay. Employee benefits programs. Okay. If you're self-employed, you're an employee through an S Corp and you have a benefits program for yourself, which is your health insurance, you can deduct that. Okay. Mortgage interest. Okay. This is again part of the home office deduction. Okay. Interest on your business credit cards. If you have a credit card that you've racked up and you're paying interest on it, that is deductible. Okay. So if you got credit card debt and it's used for business, that is deductible. You guys should all have an account or a credit card or something like that that is strictly for business use. Okay. Strictly for business use, makes it really easy to track all your purchases, things like that. Okay. Legal and professional services. When you do go to file your taxes, okay, you're self-employed or you're in an S corporation, the payment that you make to your CPA to file your taxes is tax deductible. Okay. It's an expense for your business. Okay. Contributions to employee pension or retirement plans. We're about to talk about that. Okay. You make a contribution to your employee, which is you, to their retirement plan, tax deductible. Okay. This is another reason to do a 401k or to do an S corporation. If you're an S corporation, you are now an employee and your employer, your S corporation, can offer you things such as a 401k. So people are like, oh, I'm self-employed, I don't have a 401k. You can get a 401k, form an S corporation, make yourself an employee. Now you have a 401k. Okay. So a lot of different stuff there. All right. Questions on write-offs, questions on tax deductions.
Question.
Sweet. Sorry.
Can you hear me?
Yeah, sorry. Go ahead.
So if you don't have a strictly used for business, how do you, like, if I haven't set that up yet, what's the best way in tracking expenses?
Yeah. So let's show you that. So I use, first of all, I use QuickBooks Self-Employed. You can see on my little thing here. QuickBooks Self-Employed is costs about $15 a month or something like that. But there's a free one called Wave that's like QuickBooks. I'll show you a Wave account. So Wave is pretty cool in that, and I used to use Wave. Let's see, I use Wave still to do my rental properties. But let's see here if I've got some of my old stuff. So I changed over from Wave and started using QuickBooks because QuickBooks has a few more options, doesn't have quite as many limitations, but for a basic, I used Wave for my first 3 years or so. So let me show you here. So within Wave, you can actually attach your credit card or your bank account that you use, and it will automatically pull in all of your transactions from your bank accounts. Okay. I think this is, let's see here. Yeah, okay, so this is some of my stuff from probably back in the day. Let's see when this is. No, that's not what I want. Give me one sec here. And this is kind of one of the requirements of a, yeah, here we go, this will work. This is kind of one of the requirements of having like an S corporation, okay? So again, it's that you have some sort of, tracking in here, okay? Now, the way that this works is, and this will go back, I think, 1.5 years for me. And it must have changed something at some point, but they were not always uncategorized. I categorized all my expenses. Okay, but the way this works is it pulls in all of your transactions from your credit card or your bank account. Okay, and you can see here, you know, it pulled it in from BuildASign, right? And let's see if it, under my transaction details, let's see if I have any information on it. So it just says, hey, I paid BuildASign $95.49 in August of 2018. Again, these should be categorized, and it must have changed something over, but anyway, once you do this, you can do advertising. Oh, I know what happened. Sorry. So when I changed over my accounts, it eliminated a lot of my categories and then it got rid of them. But your categories will automatically be in there. So BuildASign would have been an advertising expense. Okay. So when you go through here, all of these things will be categorized. And then at the end of the year, you're going to have a profit and loss. Okay. So you can see here, for example, Realty 360 View. That is a company that takes photos. So I probably got photos for one of my listings. Stephen Wagner and Associates, they're who do my taxes. So I paid them to do my taxes. Here was an income for a closing. Okay. Ticketmaster, don't know what that is. And some of these, like I said, I don't know if I put an expense in here. And then also in here, you can put in here if a personal expense ended up on your card or something like that, you can just delete it out, or you can categorize it as a personal expense. Okay. Golf club, I probably took a client golfing or something like that. We've got another picture here, Virtuance. Here's an income of a closing. Okay. Here, I probably took a client out to lunch or something like that. Okay. Here's a closing gift. Here's another, oh, I actually remember this one. I bought burritos for a meeting. Okay. Another closing. Okay. So all this stuff gets pulled in from your accounts, and then it gets categorized. And then at the end of the year, let's do something like this. I know this one's up to date. So then at the end of the year, you can create this report. Okay, so you go to reports, you create an income statement or a profit and loss, and this is kind of what you give to your accountant. And it shows all the different types of expenses and how your deductions are lined up. So you create your own types of accounts, and it'll be like advertising, office fees, insurance, and it'll create this profit and loss. Okay, so waveapps.com is the company that is free that will do this and will attach to your credit card or will attach to your bank account or whatever. Okay. If you want something a little bit more intuitive, you can use QuickBooks. Okay. And same thing, it'll categorize everything for you. And this is what you should do. So, you know, basically I reconcile my accounts usually once or twice a month. All of my expenses get pulled in from my credit cards and or from my bank accounts. Okay, and then I categorize them. So I just go in and I go, this was advertising, this was a rental fee or whatever it is. And then at the end of the year, all you have to do is print out your profit and loss. You don't have to go fish through a bunch of receipts. You don't have to, you don't have to do any of that stuff. And with QuickBooks, and I think actually Wave has it as well. I think they both have apps for your cell phone where when you make a purchase, you can actually quick snap like a picture. You can quick snap a picture of the receipt and upload it to that transaction as well. And then all of your receipts will be attached to all of your transactions. Is that helpful? Okay.
Very much so. Thank you.
Perfect. And there's other companies that do this. Quicken is another one. So Quicken is another one that you can use. QuickBooks Online, obviously Wave is the free one, but they're all really good, and they're sufficient. But I think for people just getting started, Wave is perfectly sufficient. And then just open a credit card, open a credit card in your business name or something like that. So you can do a business account. I use Capital One business cards. They give 2% cash back, which is really nice. At the end of the year, I've got a lot of business expenses, so at the end of the year, I get a couple $1,000 back around Christmas. Make everybody, have everybody have a nice little Christmas. So, so anyway, find a good cash back or a mileage card or something like that. Just don't carry a balance. Okay, that's my number one. The number one thing, don't carry a credit card balance. Okay, credit card debt is not good. So pay it off every month. All right, any questions from there? All right, next. Let's talk a little bit about retirement. So for those of you, maybe, again, we're talking about how are we going to get to the point where we're able to retire and we can enjoy what we've done for a while, because when we're self-employed, it's really difficult, guys. You get a $10,000 check, and by the time it gets taken all the different directions it has to get taken, there's not much left over, right? You go, okay, we got $10,000. I got to pay my cap to Remax. So now I got 7,000, then I should be putting, 20, 30% away for taxes. So now I'm down to 5,000, and then I got to pay my mortgage. So now I'm down to 3,000, and then I got to pay for food and phone and car and that kind of stuff. And now I'm down to 1,500, and I don't know where my next deal is coming from. So all of a sudden you get $1,500 in the bank, and you know that, man, I don't even have anything else on tap, and I don't know when I'm going to get paid again. So, a lot of us aren't thinking, what are we going to do for retirement? So I've been since day one, since the day I started working, my mentality was like, okay, pay myself first. So pay yourself first, reinvest in your business second, and then pay all your bills third. Okay. So my personal opinion is, if you get a $10,000 check, the first $500, the first $1,000, whatever it is that you determine is right for you, goes into your savings or goes into your retirement account or whatever it may be, before you do anything else. You don't do it with what's left over, because I can guarantee you're going to find a way to have nothing left over. Okay. So a couple things. First of all, if you guys don't have, I think the first piece would be a Roth IRA. In my opinion, a Roth IRA is probably the best thing that you can do, because all of your gains in a Roth IRA are tax-free. Okay. So if you start investing in a Roth IRA, and you can put up to, I think it's $6,000 per year right now. So you can put up to $6,000 per year in a Roth IRA, and you can invest that in the stock market. You can invest it in property if you want to. So you can buy the house with it. You can buy cryptocurrency with it. There's all kinds of different ways you can invest your Roth IRA. But the gains within your Roth IRA, when you take them out of the IRA at 60 years old, the gains are tax-free. So this is a great opportunity for you guys to shelter some of your tax-free gains. Okay. There is a certain point that you get limited on your ability to contribute to an AGI. This is a good, or to your Roth IRA, I'm sorry. This is a good problem to have. Once you're making enough money that the government says, nope, no more tax deferred gains, it's a good problem to have. I think the contribution, I'm trying to think what the income limits are on this stuff. Yeah, let's see. So if you're making over $200,000 a year, essentially, then you're limited and you can't contribute to a Roth. So again, kind of a good problem to have. So if you can't contribute to a Roth, then your next best plan is to move into either a 401k provided by your employer, which your employer is going to be your S Corp, or you can do a simplified employee pension, which is here. We call it a SEP IRA or an SEP IRA. Okay. The nice thing about the SEP IRA is that the contribution limits are significantly higher than a traditional or a Roth IRA. Okay, so the traditional and Roth IRAs are right around $6,000 of contribution limits for us per year. Right? A SEP IRA or a 401k are both the same as far as contribution limits are concerned. Okay, the contribution limits on these are $58,000 per year. Okay, so you can see here how much can I contribute to my SEP. The contributions you make to an employee's SEP IRA each year cannot exceed the lesser of 25% of compensation or $58,000. Okay, so if you make $100,000 per year, you can actually put in, now again, let's put it this way. If you do $50,000 or $100,000 per year into an S corporation, you should be distributing 50 and salary 50. Okay, since your salary is 50, that is your compensation. So you can do 25% from your company of that compensation amount, which would be $12,500. Your employer can contribute $12,500 to a SEP IRA on your behalf. So that would come out of your distributions, for example. Okay, so the maximum that you can do is 58,000. Again, really good problem to have. If you're making enough money that you can put away $58,000, if that's 25% of your income, okay, into your SEP IRA, it's a good problem to have. But this is a great opportunity for you guys to move some things into tax deferred or tax-free accounts. Okay. Again, a Roth IRA gets taxed when you make the money and then you put it in, and then everything that you make in that account when you retire is tax-free. A SEP IRA or a traditional IRA, okay, you don't get taxed on the front end and you'll get taxed when you pull it out on the back end when you're at retirement age. Okay, so again, talk to your CPA, talk to a financial advisor, find out which one of these is going to be best for you. But there are opportunities for people who are self-employed to save for retirement. So don't make excuses that, oh, I'm self-employed, I don't have a 401k, or I don't have a pension, or I don't have the ability to save for retirement, because it's just not true. Okay, any questions on that? Okay. Retirement plans, Roth IRAs. That might be it. We talked about, let's see, we talked about S corporations. We talked about deductions. We talked about different types of retirement plans, and we talked about our accounting. Okay. If you're going to do an S corporation, guys, you need to have an accounting system. Okay. So you need to have some type of, here's how we're going to track our profits and our expenses. Okay. And then that way you can print this out at the end of the year and give it to your accountant. Really easy. Okay. Actually, let's look at this one here. This one will show some good stuff, I think. Okay, they haven't been a lot of them haven't been categorized yet, but this shows all of expenses associated with a rental property. Okay, so we've got different types of. Oh, this goes back further than I wanted it to. It actually goes like to here. So anyway, you've got different types of things here. So like here we go, and this isn't currently an uncategorized expense, this SOS registration fee. That's the Secretary of State. So it costs us $50 to do an LLC. Okay. And so when you go into your expenses, it's going to ask what type of expense account you want to put it in. Okay. So here, I'll show you. So if you were to do incorporate and do an LLC, I would consider this to be a professional fee. Okay. And depending on what company you use, if you use QuickBooks, they may have something like association fees or licensing fees or something like that. And you can create as many categories as you want. So if you want to go in and create like a licensing fee, you can do that. Okay. Let's see what else we got here. Like, here we go. Summit County. Okay. This again is another licensing fee for this property. So there's a licensing fee here. So this would go in, we categorize this as a professional fee. So again, what I'm doing here is on a, every other week, monthly basis, I go in, I look at all my stuff that gets pulled in automatically from my credit card. You can see it comes in from a Spark, Capital One Spark card, gets automatically pulled in, and then I just categorize it, okay? Makes it really simple if you put all of your expenses in one account. If you don't want to do a credit card and you prefer to do a debit card, no problem. This will link to your bank account, and then it'll pull all your transactions from your bank account, okay? All right, do you guys have any other questions?
Yeah, Nick. So obviously at this point in my career, it's not, really worth it to do an S corporation, but solid accounting just on Excel spreadsheet of what I've been spending thus far. I'm terrible at keeping receipts though. Is that going to be sufficient, just sort of at the place that I'm at come the end of the year to have
So first of all,
itemized, Excel?
Yeah, so Excel's probably fine. I can tell you that the more organized you are with stuff like this, or if you do, as long as you have stuff like fully itemized in your Excel spreadsheet, the more unlikely it is that your that the IRS, if they do audit you, is going to ask for actual receipts. Okay, because so for example, I'm not good at keeping receipts. Like if the IRS comes and asks me for all of my receipts, I'm going to be in trouble because I'm going to have to basically go back and source every receipt. So I'll go back and I'll look at the credit card charge and I'll be like, all right, I bought something from Home Depot. And then I'm going to have to go into my Home Depot account and see if I can reproduce the receipt, right? The reality is when you've got an accounting system like this set up where everything is categorized, you can show that it was actually paid for on your credit card. They don't really have a reason for the receipt. The receipt is there to prove that the expense is actually for something that should be written off. Okay, but for example, if you show a charge on your credit card from the Denver Metro Association of Realtors, the IRS doesn't need a receipt. They know that that's an expense for you as being a real estate agent. It's on your credit card. You can give them a credit card statement that shows it. They probably don't need the actual receipt. Okay, so my good answer is yes, you should keep all of your receipts. Your CPA is going to say keep all your receipts. Your organization comes in your spreadsheet or comes in Quicken or in Wave. Your receipts can literally be in a King Soopers bag. They can be in a shoebox. And then if the CPA or if the IRS ever comes to audit you, you literally can hand them the shoebox and go, good luck. That's their job to sort through that shit, not yours. Okay, so you don't have to organize your receipts. So, if you're at least good enough, I'm not even good enough to do that. I'm not even good enough to keep my receipts. Literally, if someone hands me a paper receipt, I'm going to lose it in 5 seconds. Okay, it's going to be like, somewhere in the seats of my car. Like, it's just not going to go where it needs to go. But if you can at least put a bag in your car or something like that you can stuff all your receipts into and keep your yearly receipts, if you ever do get audited, you're fine because you can literally just hand a bag of receipts to the IRS and go, good luck, you can figure it out. Everything should match up though. Okay. And worst case scenario, they can't find a receipt for something that you wrote off, that they can't find any proof of it. You go, all right, sorry, pull the $154.79 off of there and I'll pay you the taxes I owe on it. To me, that's worst case scenario.
So, Mauro, I signed up for, a business credit card and this Wave. Do you know if Wave has the option of me going back in and manually and entering in the small amount of stuff that I've got in my Excel?
Yeah, you can manually enter it. And actually, you can either manually enter it or a lot of these have an import program from Excel. So you could actually potentially, depending on how well your Excel spreadsheet is set up, you could potentially import it. But yeah,
Okay, sweet. Thank you.
cool. Anything else?
I have a question about writing stuff off. Like for example, my boyfriend supports me while I'm getting my career going. So if I did, excuse me, a business expense his account or his debit card, does that matter if it's not in my name
Nope.
or? Okay,
Nope,
it's
it's
not a
still
big
your
deal.
expense. It's still your expense.
Yeah.
So yeah, you can I would expense it 100%. And by the way, you can take a loss.
Okay.
So some people in their first years of real estate, you will spend more money than you make, and you can take a loss. And then if you file taxes jointly with your partner, it'll offset some of their income as well. Or I can't remember if they're, again, question for your CPA. I don't remember if you can carry over deduction losses, but yes, if your partner pays for something, absolutely create yourself an account like this and put it in there, because again, the chances that you get audited are low anyway. So just put the expense in here, whether it comes from his credit card or not. So sometimes, like, my wife will run out and buy something for me. I'll be like, hey, can you go grab me this for this event we got coming up or whatever, and she'll put it on her credit card, and I'll just be like, hey, how much was it? And then I'll just go in and I'll drop it into my QuickBooks. What else? All right. Well, that's it from me. Hopefully that was informational to you guys about the business stuff. One other quick thing I'll tell you is that buying real estate as a self-employed person can be frustrating and can be difficult, because it's not like having W-2 income. You have to have 2 years, 2 years history of your income. However, if you go Freddie Mac, and you've got 5 years of history with your business, with your S corporation, for example, you only need 1 year returns. So if you have a desire at some point to start purchasing real estate down the road, I also recommend that maybe you start that S corporation, just so that when you do get 5 years down the road, you only have to use your latest year of tax returns. And what's nice about that is if you have a really good year that prior year, but a kind of a crappy year the year before, if you go Fannie, you're not going to be able to be approved because they need 2 years history. If you got Freddie and you have a 5 year, if you've been in business for at least 5 years, you only need 1 year return. Okay. So I can tell you that for me, for example, having that 5 years is really significant, because each year as my income grows, it means my buying power increases. Okay. So, might be worth it if you have some desire or some intent to purchase real estate down the road. Might be worth setting up that S corporation, that LLC with the Secretary of State, just so that it shows that you were established in 2021. Even if you're not making a lot of money there, at least down the road in 2026, when you are making good money, you can show that you have a 5 year history of that business being open, and you can get qualified a little bit more easily. Okay. So something to talk to a lender about as well. So, all right, guys. Well, if you don't have any more questions, we'll end it there for today. Hope these last 7-8 weeks, however long it's been, have been informational for you, and you'll continue to learn. That's the biggest thing I can tell you guys, is continue to learn and educate yourselves every day, so that you can properly educate your clients, and that you can grow as your own business owner. And so hope you guys have you should all have my information. Feel free to keep my phone number saved in your phone. I'm always happy to answer questions. Feel free to text me, call me, and I'll reach back out in a couple of weeks or in a month or so when we start the classes up again. I will let you guys all know. So if you want to join back in, you're certainly welcome to do that. Take the classes again. And I wish all of you the best of luck and the most success. And if there's any way that I can help, I am always happy to do so. So thank you guys. And let me know if there's anything I can do for you.
Yeah, thank you.
You're welcome. Take care, everybody.
Thanks, Nick.
You bet.
Thank you, Nick.
You bet.
Thanks, Nick.